Hey, this is Matt from InvestQuant. Today is Wednesday, October 7th, 2020. Yesterday, the markets saw a big down day when the markets reversed from their highs in the afternoon on news. It gave us a really large ranged candle that closed near the lows. And this afternoon, we have seen mostly consolidation-like activity after a quick pop off the open. So it's been fairly quiet after that large range day yesterday. And if you look at the charts here, you can see today's action is completely inside of yesterday's action. So yesterday, you've got the high up here in the top left chart at 34.2175 and the low down here at 33.4375. This is an S&P chart. Next to that, you see today's action where we are just trading within that range. We haven't really done a whole lot other than a quick pop off the open, and then we've gone sideways, and we've got what's called an inside day forming. And what I want to do this afternoon is take a look at what has happened historically as we approach the close with an inside day that is forming on the heels of a big down day. So we can define all of that and discover, and that's exactly what we're going to do. We're going to do it in all four instruments. We're going to use an intraday time-based entry that gets long at 3 p.m. Eastern Time and exits at the close of regular trading hours, which is 4:15 p.m. Eastern Time. For the opening filter, I'm going to use a gap up, as we did this morning, and then I'm going to go into the post-open filters, and this is where I can add information around what has happened between the open of regular trading hours and the entry time for the setup that we're looking at, which I've got set at 3 p.m. And what I want to say is the gap has not filled, so the market never retested the prior day's closing price, and we have a lower high and a higher low. So I can go down to this intraday high versus the daily levels, and I can say that the intraday high is not greater than the prior day high. So I just hit the minus sign there. That makes it a not statement. And I can do the same thing for the intraday low. And I can say today's intraday low is not less than the prior day low. If I hit minus next to that, it adds it to the test. And this forms our inside day that is taking place currently. Next, I want to go to the price patterns, and I want to put some context around what happened yesterday. And a couple ways to do that I'm looking at here is simply closing below the opening print. So if I come over to the active today, just hit close less than open. That means yesterday was a red candlestick. And then in addition to that, I'm going to go down to the range of the last session. I'm going to say yesterday was a WR4. It was technically a WR7, but I'm going to keep a little bit more samples and go with WR4. And that just means yesterday's action was the widest range of the prior 3 days. So you've got yesterday plus 3 days makes a 4-day pattern. And yesterday's range was the widest of the prior 4 days. So I've got that selected. Lastly, I'm going to put this above a 200-day simple moving average to be in a somewhat like environment, and then hit view results. And here we go. So these are the results of going long at 3 p.m. Eastern Time, exiting at the close, which is 4:15 p.m. Eastern Time, when you gap up after a wide range 4-day that was a red candlestick that closed above a 200-day moving average. The following session is a gap up that is not filled, and it is trading completely within the prior day's range, so an inside day forming. Historically, that has happened 46 times in the S&P, 35 in the NASDAQ, 48 in the Dow, and 35 in the Russell. And if we look at the win rates on these, you'll see the S&P win rate about 61%, the NASDAQ a little bit stronger, 63%, the Dow coming in at 58%, and the Russell 60%. So all four instruments with this pattern in play have historically favored the long side a little bit more frequently going into the close. Now let's also take a look at the average win and average loss. And if we look at those, you can see the average win for the S&P quite a bit larger than the average loss. That is also true in the NASDAQ. It's true for the Dow and true for the Russell. So all of these have a win rate that has slightly favored the long side, and then the average win on all of these are all larger than the average loss. So historically, that has had a lean to the long side as we approach the close. Let's take a quick look at the results distribution. I've got the S&P selected here, and we can kind of see this visually as well. And if you haven't seen this chart, the way it is laid out is you've got trade counts plotted on the vertical axis. So the taller the bar, the higher the trade count. On the horizontal axis, you've got P&L in dollars. with those left of 0. This is the 0 line right here in the middle. To the left of that are red bars, and they represent negative trades, so trades that would have lost money historically. To the right of 0, you've got the green bars. Those would have been winning trades historically. And again, the taller the bar, the more frequently that win has taken place. You can see the most common trade here is a small winning trade. And then second most common trade is going to be a small losing trade. Beyond that small losing trade, the trade counts here really drop off. So there's these bars right here next to it are very small. They don't happen very frequently. There are no outliers to the far left, so no major losing trades in this scenario. And then on the positive side, you see the most common trade where this average trade line is at. And then they start to drop off. These bars, though, are taller than what we were seeing on the downside here. So definitely happening more common on the upside. And then there are just a couple of bigger wins. They're not extreme wins, but a couple bigger wins on the upside as well. So historically, this has favored the long side a little bit more as we approach the close. So hopefully you found that helpful. Good luck the rest of the day, and we will see you next time.